Today I want to talk about my personal investing strategy with the goal of reaching a $100,000 portfolio and beyond. My strategy has developed from my experience and investment preferences. Therefore, it may be that the same strategy doesn't apply to you. I think it's good to first talk about where I currently stand with my portfolio. I'm currently at $78,000, which is not that far away from a $100,000 portfolio. I think that if the market cooperates, I should get there by the end of this year. And it's also my goal to reach a $100,000 portfolio this year. If I do make it, if it's this year or the next, in the end it doesn't really matter, of course, as long as I get there. My plan is to keep going from there, and my next goal will become to scale this portfolio to a million. And I believe that this strategy is so evolved by now that it should be able to get me there. Now let's get deeper into my strategy. My strategy exists out of 5 different principles, which are diversification, position sizing, when to buy, when to sell, and options or options trading, which is also a part of my strategy. Now let me go through each of those principles. The first principle, diversification. As you've probably heard before, you shouldn't put all your eggs in one basket. This principle also applies to investing. Let's say you buy only 3 different stocks and one of the companies goes under, then you've immediately lost a third of your money. Since I invest a large portion of my wealth in this portfolio, I find diversification very important and I stick to a maximum of 25 positions. Some may say that's too many to manage, but I enjoy staying on top of it, which makes it much easier for me to hold on to so many positions. The advantage of having fewer positions, though, is that you can dive a bit deeper into your research. On the left, you can see an overview of my current positions, and you'll notice that not only are there many positions, but they also represent a variety of business models. From top to bottom, for example, a social media and advertising company, an AI software company, a payment processing company, a snacks and beverage producer, a broadly diversified tech company, an e-commerce company, and I could go on. Maintaining 25 positions is quite a lot, and if I were to hold even more, it would come at the expense of the quality of the portfolio. When I reach 25 positions and see a stock I'd like to add, I'll have to make a decision on whether it's wise to trade an existing position for a new one. When selecting positions, I look at both growth and value stocks and try to pick stocks from different areas and sectors for even better diversification. Additionally, I buy mega caps, large caps, mid caps, and small caps. I try to avoid companies that are struggling and prefer to buy companies at a good price or good companies for a good price. On top of that, I allow myself to add a maximum of one turnaround play and one unprofitable stock. I do this because there are companies with a lot of potential but also a lot of risk. So I want to prevent them from having too much of an impact if things go wrong. What is also very important next to diversification is position sizing. Because if I have diversification right and I have 25 positions, but I have 90% of the money in just one position, then am I really diversified? No, I am not. And the risk would still be there that if that stock or company would fall, I would lose 90% of my money, even though I can be diversified over the amount of positions and the regions or sectors. So how I avoid my position sizing to go wrong or to get off is I avoid buying too big in the first place. So it can be, or this means that if I buy a company that I like for a good price, and the company goes up, there's a chance that the company or position will be getting towards 20% of the full portfolio. For a portfolio with 25 positions, that is quite a big position. But I would never have it holding 25 positions buy a stock until it's 20% of the portfolio. So the only time that would really happen is if a stock goes up so much that because of the stock price appreciating, that the position is worth a bigger part of the portfolio. And that also brings me to the second point, which is conviction. The more conviction I have in a stock, or the more faith that a company will do very well, and the risks are combined are lower, then I will be able to put more in such a position than I would in a position I have less conviction in. So the biggest positions usually are the positions that I have the most conviction in, or those can also be the stocks that have gone up the most, which is not necessarily a reason for me to sell right away. Next to that, there also needs to be some balance. And what I mean by that is that, let's say I have 20 positions that are holding 90% of the portfolio, or even 99%. And the remaining 5 positions, if I hold 25 at the moment, are only worth 1% of of the portfolio, then is it really worth it to have those 5 positions that do not really do anything? They need to go up probably 1,000% for me to even notice it. And that's what I mean by balance. So there needs to be some balance in the position sizing, or else, yeah, you would just not get out of anything of the smaller positions, and then it's just not worth your time to have those positions in your portfolio. The next important principle is, when do I buy a stock? First off, I always avoid FOMO. It's in human nature to buy stocks when they go up and sentiment is good and there's only good news going around. But like Warren Buffett says, be fearful when others are greedy. And what that means is that if a stock only goes up and there is a really good sentiment and everyone is just buying, and then there only needs to be some bearish news or one thing that can go wrong will lead the stock to fall a whole lot. And the same applies to markets, of course. The other way around, Warren Buffett says, be greedy when others are fearful. Meaning that if the market already dropped and it's down and people do not dare to buy because that is in human nature, it's probably, or most of the times, the best moment to buy a stock. And now this does not apply in individual stock buying to all companies, of course, because there are companies, or if you pick the wrong company, they can go bankrupt and you lose all your money, or they have bad fundamentals and you will just not make any profits, which is something you also want to avoid. And that is what gets me to my second point, which is analyzing fundamentals. I always try to analyze the fundamentals of a company as good as I can by looking into the financials, for example, the revenue, the net income, free cash flows. Are they growing or are they declining? Next to that, I also look to the balance sheet. Do they have more assets than liabilities? And what do those exist out of? Is it debt, or do they have a lot of cash? What do they do with the cash and with the debt? Are they paying off debt or increasing the amount of debt? All things you can analyze to make sure you get a better understanding of the company, which is also the next point. And by understanding the company, one other important thing I must say is looking at the metrics and also at conference calls. So that means the quarterly earnings. There's mostly a webcast in which you can see a presentation of the company each quarter, which is very useful to not only find out about the fundamentals of the company, but also to understand the company and understand where the company is going, what their goals are, and what the trajectory is. And by looking into those fundamentals and into the presentation or earnings call, you get a better understanding of the company, and this can give you the conviction you need to see chances in the market and to eventually buy a company. And if you analyze the fundamentals and you understand the company on a high enough level, um, you are not at risk of panic selling your stocks when there is any negative sentiment or news in the around the company itself or in the markets. Another one I am always looking at, which is really important, is the historical valuation of the stock. Some people only check the valuation right now and compare it to other stocks in the same sector, for example. But just looking at the valuation of a stock, if it doesn't really matter if some people look at the price to earnings ratio. I look to price to earnings ratio, but I also look to price to cash flow ratio, for example. It's always good, in my eyes, to look at the historical valuation or the historical metrics. So let's say I would look not to the current valuation around a price to free cash flow, but I would preferably look at the price to free cash flow ratio over the past 5 years and see if, compared to the past 5 years, if this stock is in a lower valuation territory or in a higher valuation territory. I believe that says more about the valuation of a stock than looking or comparing it to other sectors, or by just looking at the valuation that it is at now. Next to that, my last point is I always try to DCA on the way down. I can give you one example. Let's say Amazon is at $200 and I want to buy five stocks. So I would start a position in Amazon for $1,000. There's two things that can happen. The stock can go up, which means I won't be buying any more, but I do make profits, of course, on my initial position. If the stock goes down, which I would prefer to happen if I didn't build a big enough position, then let's say it drops to $180, and I buy another five stocks for cheaper than the first five, of course. And this means that my average buy price has gone down to $190. And the advantage of this is that after the stock starts going up, I will make profits a lot sooner than I would have if I would just immediately have bought 10 shares. Because if I would have done that, I would not have enough money left to buy five shares on a lower price. Those are the things I consider when buying a stock. Next to buying stocks, sometimes I also sell stocks, of course, and I have a few reasons to sell a stock. One of the reasons to sell a stock for me is the story changes. What I mean by that is, let's say I bought a company for the story they told me and the goals they want to achieve. I analyzed the fundamentals and I created my own thesis for the stock and created a trajectory in my head to where the company should go. And something in the company, maybe by management or by other factors like like sales or things that happen in the economy. If that changes my thesis in the stock, I need to sell the stock because I no longer have faith in the thesis I bought the stock for. The second reason for me to sell a stock is losing trust or faith in the company. Something like this could happen if the company commits fraud, for example. Another one is when a company is way overpriced. If a company's valuation gets so high that I do not see a way in which the stock will return me any profits over the next few years, and I see a high risk of the stock price falling back, and there is a chance I will take some profits. I will not necessarily sell my all of my position because there's a chance it's a really good company, but I will definitely take some profit if it gets too much overpriced. The last one is if I find better opportunities in the market. So let's say I hold 25 positions, like I told you before, and I see a company that should be in my portfolio, and I'd rather have it than one of my already um, than the positions I already have in my portfolio. Then I can sell one of those and buy another one in return because I believe that is a better opportunity and that will bring me higher profits along the way. Those are the reasons for me to sell a stock. Next to trading stocks, I also do some option trading, but I do have some rules for that because it can be very risky. One of the rules is minimize option buying to less than 5% of the total portfolio valuation at all times. The next one is to only sell puts for the right stock and the right price. And the reason for that is if I do get assigned on the put and I need to buy 100 shares, it better be a stock I can hold on to for the long term. And I also at all times want to have those positions below 10% of the portfolio value. Another rule is selling calls on higher valuations. I can sell calls, but not if I believe the stock goes can go up a lot, and just to receive some short-term premium, because I would risk losing a lot of gains if I sell calls all the time on all my stocks. To add on to that, I only sell covered calls because I really do not want to bet the whole farm. Now that you have some insight into my strategy, I have to say that it will continue to evolve. Over the past years, it has developed in such a way that these are the things I focus on now. Of course, my preferences may change, or I may learn new things that could lead me to adjust my strategy. In broad terms, I think these are the principles I'll continue to focus on. If I manage to scale my portfolio to a million, it will probably be worth taking on a bit less risk. That's it for today. Please note that this is not financial advice. You can find the full disclaimer in the description. Please like, subscribe, and thank you for watching.